Okay, welcome everybody to another Learn It Live webinar for Pepperstone. Tonight we're going to be talking about how to trade US earnings season, very important, especially this time around. This earnings season is incredibly important to what's going to happen to the market over the next coming months. And my name's Thomas Atkinson, as always, joined by Tyrone Abella, and we're from FX Evolution. Tyrone, how have you been?
Yeah, good. Hi, everyone, and yeah, welcome to tonight's webinar. Certainly a timely one, given that we're in the midst of probably one of the most important earning seasons we've had in a long time. Not so much because we're expecting, I guess, outperformance or anything crazy like that. We're really trying to judge what sort of performance they're going to have in terms of the shutdowns. I think that's probably going to be the most anticipated earnings that we've seen, mainly because there's so many unknowns. So it's going to be a really, really interesting period. But that's going to potentially play havoc on some of the markets, good or bad. So yeah, we'll certainly get into some of that tonight and see what we can identify.
Absolutely, Ty. So just a quick update, always pushing the Telegram groups and obviously the YouTube channels where Pepperstone and obviously us at FX Evolution, we're always pushing out as much content as we can. We understand there's a lot of changes happening in the market. So please look at the links that we're going to post in the chat room in a second and feel free to follow it. These are all obviously free links and there's some great information there. Pepperstone's Telegram is amazing. It obviously provides up-to-date quick snippets on news information that's coming out. Also a top 5 kind of tips in the morning, which is excellent to read every morning if you're waking up, have a coffee or tea, and then check out all of the stuff that happened overnight in the US if you're in Australia. And of course, our public chat is where traders can, I guess, share trading ideas. So if you want to share some trading ideas, have a chat with other traders around the world during this isolation period, it's a great way to get involved and get social on that aspect. So what are we going to be covering today, Ty? It looks like we're going to be looking at a few things. So basically a look at key economic concerns and a technical analysis approach to levels for specific stocks. So we're going to be taking a look at some big stocks that are coming up with announcement and obviously some that have already made some announcements. So we'll take a look at what we expect, what will happen. It's going to be a mixed bag. Some companies are going to do well off this stimulus and what's happening at the moment. Some may not do as well. We'll be looking then at how US indices are having a huge impact on currencies like the Australian dollar and the New Zealand dollar. They're actually very similar in terms of their movements, and we'll be looking at the synergies between those. Got a good little overlay chart that Chris Weston put up the other day, so we'll take a look at that and what's going to happen. Economic calendar for key stocks, so we'll look at a few key stocks that are probably going to make or break this rally. If this rally is going to succeed, you'll need these stocks to perform well. If these stocks don't perform well in earnings reports, expect a pretty serious potential sell down. So we do need these particular stocks, like a top-down approach, and of course how to mitigate earnings risks using CFDs. So there is going to be some earnings risks, especially depending on what company you're holding. There could be some very bad results. So we'll talk about hedging and that kind of stuff. And of course then live Q&A. So feel free to ask any questions while we're going through tonight's webinar and we'll answer them as best we can. So risk warning, the information contained in this webinar and video is generic in nature and for educational purposes only. The information does not take into account your personal and objectives, financial situation or needs. And of course, it should not be considered financial advice. It's general and educational only. So, Ty, economic impacts that are currently moving the markets. So, of course, we've got the coronavirus outbreak and it's spread globally. We've got government stimulus into the economy. We saw another Fed move last Thursday, not coincidentally, right around the unemployment figure. Bad unemployment figure comes out of the US, instantly matched with some seriously, I'd almost call it bonkers Fed stimulus. So another was $2.3 trillion of Fed stimulus coming in. It's totally unprecedented. We traded the GFC. I can tell you that, this is just such a huge amount of money that the Fed's putting in. And that's obviously because they've got serious concerns. I mean, Ty and I were talking about today, the IMF, Ty, came out today and they've basically said we need multiple year post this problem stimulus. from central banks and governments. It's not going to just go away. Unfortunately, when you halt an economy, it's hard to restart it, and that doesn't mean that we're just going to restart it in May and it's going to come back. There might be a second wave of the virus. I mean, we're not health experts, but that could be a thing, and then we could potentially see a small change in the way that everyone has to live potentially over the next couple of years. Anything's possible, isn't it, Ty?
Yeah, it's going to be a very, very different world, no matter which way you look at it. And unfortunately, it's very difficult to predict how the global economy, even not just the US. I know we focus a lot on the US, but the global economy is going to be different. And without really knowing how those differences are going to play out, it's really the market's guessing and checking, and probably hoping for the best in a lot of ways. The way they're trying to obviously deal with that is to put an extraordinary amounts of stimulus, like compared to what they did in the GFC. Like, this is just unbelievable. So and that probably should really give us the clue. Although they're not really panicking, and they're not really trying to panic the market and saying we're going to be in a different world. You've never heard anyone of any authority or office come out and say, the world is going to be a very, very different place from an economic standpoint. I think you can probably read between the lines. I mean, that's probably just them not wanting to panic the markets. But the amount of stimulus that they're putting out is really telling us what they actually think. And we probably need to take that as the heads up that volatility is still going to be here, and we're going to see plenty of it. So it's going to be a very, very exciting trading time.
So economic figures, Ty, obviously we're going to see this US earnings season, which is what we're partially talking about tonight. But I think the thing that's going to not really show is the earnings aren't necessarily going to be the terrible thing. It's the guidance that the CEOs have to give everybody. So depending on the wording they're saying, what the guidance they're giving, remember they do have an obligation to the share market to give guidance. If they give bad guidance, you will see stocks react poorly. Obviously financial stocks and those kind of things that are potentially in the limelight of having their profits really reduced, and potentially also bad debts coming in, they're the ones that guidance is going to be very affected. Airlines, etc. All sorts of sections of the economies are going to be damaged here. So here we've got the impacts of the odd and the New Zealand currencies. So this is the SPI overlaid to the odd US dollar, and you can see the similarities in terms of the movement over time, specifically pretty much what's happened here with the uptick. Now this was taken a few days ago, but you can see, and it still has been coupled. Now, what's happened in the last, I would say, 2 hours is we've started to see the Aussie dollar sell off, and coincidentally or not coincidentally, so has the S&P 500. So it's interesting to see how correlated these particular pairs have been, and they seem to be continuing that correlation. So Aussie and New Zealand currencies very correlated. Let's jump into the charts, Ty, and actually have a look at that. So here's the Australian dollar. Now, if we look at this from a technical perspective, we can see that the Australian dollar has been shorting for a long time. This is kind of the last support that broke through. Go down to a daily, and it's basically reached right on that point where previous support was before it just fell off a cliff, and then it's come back up, tested that, gone above the blue, which is the 50 EMA on the daily, and it's found some resistance. Now, if we have a look at the US 500, we go to a daily, look how similar that is. It's come just above the 50 daily. This is actually a big Fibonacci of the pull. So it's gone just above that 50 and 61.8 fib. And if you actually look at the first pullback before the GFC, so if we pulled up an S&P 500 chart and we were actually having a look at the first sell down and then the pullback, how steep the pullback was, it's really amazing that the actual first pullback was between the 50 and the 61.8 fib, literally in the middle. It's crazy, Ty. I was actually looking at it today. I put a video out about it, but it's literally in the middle, the first pullback directly. That's where we've come to this time, and we had that previous support last year. So it's pretty amazing that when you look at the US market, we're back basically at August period last year, after hitting the 2015 kind of highs, and then we have gone all the way back up And really, nothing good has happened other than the stimulus. So you can see that really is the sugar rush, Ty. That's the sugar rush period. And I think there's a couple of ways to look at the economy, but if we consider, let's say, a few different scenarios, and again, I did a bit of a video on this, we've got the V-shaped scenario where basically we go back to work, let's say in May, nothing else happens and all economies start to do well. We don't have to close down again. And the stimulus, let's say this is the Fed stimulus. This is the Fed stimulus here. It's so big that it counteracts, let's say, the damage done by the COVID virus. So if this is the damage done by the COVID virus, this would be the counteractor. And that's a V-shaped kind of recovery scenario in terms of the injection of money from the Fed. The second option, of course, is more of a U-shape option where it's had that initial sugar rush and then it takes time and goes down a bit, stays in a range, and then eventually starts recovering after a period of time. And that's the U-shape. And that's where pretty much the damage from the COVID will pretty much be the same as the stimulus from the Fed. So if these two were very equal in terms of the stimulus was the correct amount so far that's come out, then as the stimulus gets injected into the economy, let's call this the economy, let's call this the injection into the economy. As that happens and the money starts going in, it'll take time for it to hit the right businesses. So this is why we get that initial sugar rush, and then we need to see the economics after that point. And the third kind of scenario is where we've got the Fed stimulus, and then the last point would be that the damage from the COVID virus is so big that it counteracts the Fed stimulus heavily, and then that's where we'll see lows get tested and potentially new lows. Because most of the time, Tyrone, as we know, when these types of things happen and we see potential recessions into potential even depressions, the market usually goes a little bit more than the 30% plus it did this time, doesn't it?
Yeah, and look, going on what the IMF came out today and said about what they think this recession is going to be like, probably we don't want to be too doom and gloomy on it, because I mean, all we're doing is really stating the facts. The IMF, which is the International Monetary Fund, have come out and said that they expect this economic smashing is going to be about 10%, or sorry, not 10%, 10 times worse than the GFC's economic, issues. So, that's a pretty scary thought. But it probably coincides with, the amount of stimulus being, put in already as a preemptive strike into trying to rebuild the economy as fast as possible. But we have to take heed from that, and it's difficult to believe, regardless of what the market has done, that it's recovering from here when we haven't even seen what a month's worth of impact is on the economy. It's just very difficult to believe that it's just going to keep going up from here, especially at such a key point, like we've just highlighted at this level. It's such a key area for the S&P 500. Yeah.
All right, so let's talk about earnings reports. So we've seen an earnings report from JP Morgan and Johnson & Johnson. Now they came out, I believe it was yesterday, and two different kinds of reports and two different kinds of scenarios. So there are technicals that are actually playing out in a lot of these stocks already, and we'll actually have a look at them. But I did want to talk about, not only have we seen the results from those two large companies, but we've got some very key earnings. And these are probably the ones that are, if you're looking from a top-down approach, the biggest companies in America, depending on how these guys report, and if they report in expectation, over expectation, etc., they'll really set the trend for what is going to happen to the overall market. Because remember, these are the biggest guys. So like we talk about in the technical analysis standpoint, from a fundamental side, the top-down approach makes a lot of sense as well. Look at the biggest companies because they make up the biggest percentages of the S&P or of the Dow, etc. So the most important earnings will be Microsoft, probably Apple and Amazon, most likely. Obviously, there's tons of different earnings reports that are coming out. These are the times that they will be doing their earnings. So Amazon's the 23rd, Apple's the 30th, and Microsoft's the 29th. And it'll be very interesting to see how they do. I would say some of them will do okay because obviously, some of these are tech companies. So
Yeah.
you know, there
Well,
will
we'd be
be a lot.
fully expecting, I mean, from a logical standpoint, you'd be fully expecting that Amazon will completely shoot the lights out. If they're ever going to have a good earnings report based on something that's happening in the economy, it's going to be now, because the online purchasing would be going through the roof, obviously. So it's going to be a very, very interesting report. But I think I'd almost say that it's probably going to, if I was going to have a guess, I would almost say that they've anticipated such a great report, given how it's risen. We can see on the chart here that actually anything short of outstanding is going to see this sell off probably to that double top that we can see right there as a minimum.
Oh, absolutely, Ty. So here we've got the kind of fall off, and people the whole time thought that Amazon was going to be potentially good, so it didn't fall anywhere near the percentages of the rest of the wider market. But the recovery has been incredibly fierce, and this is actually an inverse head and shoulders, Ty. You got the left shoulder, head, and right shoulder, and then you've seen that beautiful break. I mean, look when it broke through there, and then bang, that super aggressive move. And what we've found a lot recently is that if you're seeing a pattern, the market is going 80% generally of what the expectation of the pattern is. It's not always going the full kind of length, and that's because people are taking profits a little bit earlier. They are still skittish. We've got to remember the volatility index, or the VIX, is well above the 20 level, Ty. So that means that people are still freaking out to a degree, and there is a lot of jitters in the market. So once the Fed came out, and kind of the rumors, I guess, probably started of that, you saw that massive increase, and then bang, straight through, because really any kind of stimulus that Amazon's getting is probably not going to suffer too much as a business. It's just going to see maybe a little bit less consumer spending, because people are spending less because they may not have as much if we go into a full recession. So yeah, it's very interesting to see a pattern, beautiful looking pattern, and that is nice in terms of stocks. We've even seen one here in Johnson & Johnson, Ty. We've got another inverse head and shoulders, and that came off the back of the earnings reports, doing okay. There's the gap off the earnings. Got that left shoulder, head, right shoulder neckline. So if this was, let's say, a positive beneficiary of the stimulus, etc., then really, if you took this distance would be all the way above to a new high, because this is a pretty serious move that's being predicted. And it would literally put you above that $155 kind of dollar price point. And it does make sense. I mean, Johnson & Johnson probably do okay. But yeah, very interesting to see these technicals here, Ty.
Yeah, no, it is. And when you sort of think about it in terms of what they do produce, and what obviously is not suffering from this economic shutdown, or what's still in need, it's no surprise really to see that it is actually doing well. But a good earning report's obviously going to see it potentially take off again.
Yeah, so let's have a look at the multiple stages of market emotions in emoji form. So basically, this is usually what does happen. So you like the emoji form?
I do.
Yeah. I thought you'd like that. This was definitely me. This was me last year. The thrill. But yeah, basically you've got the euphoria, you've obviously got that excitement of the market continuously going up in the bull stages, and then we've definitely felt some of these feelings. So we're kind of seeing some hope at the moment. I definitely think a lot of the market has gone off in depression, but when you think about this cycle right now, it actually happens multiple times in a crash. So if you're looking at, let's say, the GFC, Ty, as we said, the market went down quite heavily, pulled up, people were feeling probably very much hope and relief at that point, and then it went to that in between 50 and 61.8, and then all of a sudden it was back to denial, fear, depression, all these kind of things. So it happens think of this as a swing in the market. If you're seeing a market go down, swinging back up, down, swinging back up, effectively it's just this, all the emojis all the time. It's amazing how that psychology is so powerful. So I think that whenever you're thinking about the market, you've got to think this is what happens, and this is why there are traps in the market. And some people are calling right now, a bull trap. Some people called, the market up here a bear trap, and all sorts of things. So yeah, this is just a very good example, I guess, of the general emotions that people go through. Now, another thing, Ty, when we're talking about US earnings season, we're talking about the potential for gaps. Okay, so market gapping is when a trading instrument opens above or below the previous close price, generally with no trading activity in between. So obviously we think of Forex with weekend gaps are particularly severe during times of high volatility, but also some stock gaps can be. And if you're trading, let's say, a volatile pair, if you're trading an airline company, okay, or a cruise company right now, and you're trading that cruise company and you take it into an earnings report, I would think that there is a possible scenario where that cruise company could move upwards of 20 to 30% off that announcement. I think, Ty, you would agree we could see some severe changes.
Yeah, and I think a lot of what we've got to keep in mind is don't necessarily assume that because it's a travel company or a lot of these companies you think are being hit really, really hard at the moment. Just be very, very mindful that a lot of the expectation is already priced in. So don't think, oh, they have to report badly, so they're going to go down. That's not always the case, because a lot of what is expected is already priced into the market. And generally what you'll find is they've probably overshot the expectation. So a lot of there's a couple of good examples like Hertz Global Holdings and Avis Budget, two of the biggest hits I've ever seen in recent history, because obviously this epidemic has impacted them as much as it has any travel company, but probably even more so because not only are people not traveling, but people aren't hiring cars, so you can't even travel. So, but a lot of that will be priced in. So their reports may not be anywhere near as bad as people think they're going to be. So it's very important not to make that assumption that just because you think, yes, they're in a really bad industry given what we're going through, that they're just going to report badly and they're going to sell off, because what you may find is that they've already been heavily, heavily sold off because of that expectation, and their report will still be bad, but it may not be as bad as prices so it's not a given. It's basically what I'm saying. Don't just automatically assume that they're going to sell off, because that's not always the case.
Yeah, it's the age-old thing. If people say, "Oh, it's crazy that this report, like they reported great and then the stock went down and there's a record profit," it's because the stock market preempts these things. So it preempted how bad obviously the virus was going to be to the economy. The Fed has then stepped in, and central banks around the world have stepped in to alleviate some of the risks that people saw in the economy. Believe me, if they didn't do that, we'd probably I think the Australian market could be under 4,000 quite easily, Ty. So
yes,
it's very important that it's a counterbalance to what the market's thinking. But the market looks 6, 12, 18 months away, and the general consensus of course, what we're looking at is right here and now usually. So you need to be somebody that can, if you're going to trade and invest, that kind of thing, you need to look. That's what the market's thinking. It's thinking far away. So what is hedging? So hedging can be considered an advanced investment strategy, but really is pretty simple. Hedging is a risk management strategy to reduce or eliminate the risk of uncertainty. So that's the big thing. So of course, why do we look to hedge? We want to protect from uncertainty. Now, during the period of obviously earnings season, if you don't want that kind of risk, or you want to hedge that risk, or you're a bit scared about the earnings, and you make a last decision that maybe I hold Hertz type, or maybe I hold Apple. I hold Apple shares, and I thought the result was going to be good, but I'm thinking now it's not going to be good, but I still want to hold my Apple shares. Well, you could potentially match the size of the Apple shares with the CFD on the opposite direction. So we did a webinar a few weeks ago on this, and I'd suggest you go and check it out on Pepperstone's YouTube channel. But the idea of hedging potentially a share is absolutely valid if you don't want to take that risk. And that goes for also weekends. If you're trading a currency pair like the euro, US dollar, and you want to still hold that trade next week, but you don't want to run the risk of the weekend gap, then you could potentially just reverse the position. So if you had one contract long, you could just sell one contract, hold those two over the weekend, and then close the hedge when the price opens on the Monday. So definitely very easy strategy from that aspect. There's always obviously more complexity to it if you want to, but yeah, you can do that ahead of news if you're a bit worried about it. I've got a question. Someone's here said that they love gaps. Well, yeah, you can love gaps when you're in the direction of the trend, but gaps against you can be pretty brutal. And I think also oil is definitely one that you'll want to be a bit careful about on the weekends. There could be some big volatility just because, of course, we've got agreements and losing agreements and a lot of uncertainty in oil at the moment. So great trade opportunity, great day trade scalp opportunity, scary in terms of weekend holding, I think, to a degree. So a few people always ask us this, what moving averages will help us during this time? I think that if you put a 20 moving average EMA and a 50 moving average EMA on your charts, you'll find that the market really respects these, especially the 20. If you were only going to put one EMA on your chart, 20 would be the one. And that's because the stock market has always used that one. It also correlates to kind of like the trade days of a month, 4 weeks, 20 days worth. And remember, it's covering 20 candles or 20 bars. So very important to use the 20 moving average. It's an essential part of any technical analysis's kind of moving average arsenal. And we'll have a quick look at why that is. But yeah, Ty, I mean, you love the 20, don't you?
Yeah, well, the 20 is the one that proves to be the most reliable in normal markets, and that's why I like it. Look, in volatile markets, it can often shoot through the 20 and head to the 50, but as a rule, you're going to find that the 20 will stand up in most market environments, which is why it's so important to us. Because I mean, it is it's almost like a mean reversion MA, really, where price seems to revert to it a lot. And in times of uncertainty where price doesn't know where it wants to go, it does often go to the 20 and gravitate there, whether it's an uptrend or a downtrend. So that's why we like it so much. And it's certainly our moving average of choice. And just look, we've got a few questions on which moving averages we've got on these charts. The red is the 20 EMA, the blue is the 50 EMA, and the 200 is a green SMA. So they're the ones that we always use on our charts. And we can see here a couple of the highlighted zones as it touches the 20. It happens all the time. There's not many charts that you can't pull up where you're not going to see, a dozen good touches of the 20, whether it's going up or down. So, and just to answer a quick question, a few people are asking about can we look at individual pairs? We've got a webinar that we're starting in half an hour from now. I'll post a link in the chat window. We're going to be looking at the individual currency pairs and what's happening in the market right now in those webinars. Okay, this is more focused on the topic at hand. So I'll pop that in there now, and you can just log into that one and join us at our next webinar, which is also free, and you'll be able to check the analysis of the current markets in that one.
You can absolutely, a few people have asked, you can use the 20 on any time frame. Absolutely. It'll work on, it's good on all time frames. It doesn't matter which one, 1 minute, 5 minute, 1 day, 1 week, 1 month, doesn't matter.
And it is very important. Probably one thing I will highlight, and I see there was a question about it, that the 20 moving average will change on the time frames as you go through them. Like, it's not going to be the same moving average, okay? So it is very, very adaptive. All moving averages are, of course, because the moving average is only that moving average of that particular time frame. So, a 20 moving average on a 15-minute chart is going to be basically using 15-minute candles. So, a 20 moving average on a daily chart is going to be using the last 20 candles, which are obviously 20 days. So it's very, very important to work out and understand that the bigger the time frame, and it goes for patterns and everything, the bigger the time frame, the more important the signal, and that includes moving averages. So a 20 moving average on a daily chart and a weekly chart is a big deal.
Absolutely, it is, Ty. And I think it's even potentially 20 moving average here is pretty big. So I've just highlighted some points here, and obviously it busted through there quickly on the US 500. So you can see on this 4-hour chart, which seems to be where some of the best trading has been happening with the S&P 500, that during the sell-off, it really, especially this second leg, it was really respecting that 20 during that aggressive sell-off. Kind of down with the balance up, bang, bang, bang each way. Now, after it's come through, you can see the 20 acted as dynamic support, and it may do so again, but this will be a critical juncture. So if we zoom this in, we're actually going to see a relatively critical juncture around this 27.82, where it's potentially going to come down even tonight and test the 20 moving average. Now, we haven't seen a break below the 20 moving average for a while. We do have a lot sitting here. So in essence, if you're looking at it from a technical perspective, if it does get through that 20 and it starts selling off, it makes a lot of sense for it to potentially kind of find some dynamic support here with the 2 moving averages. But also, I think this will be the biggest key level for the S&P in the future coming week through earnings season. 2650, 2641. Previous resistances broke through last week, resistance even over here. And if it gets through this zone, really exposes so many levels. It exposes pretty much the 2450 and then it exposes the previous lows. So multiple kind of key supports will be open if it gets under this zone. And there's a lot of what Tyron and I call free space. So if these levels were breached, what usually happens is it moves very quickly or gravitates very quickly to the next zone. So very quickly, I would expect if this level breached, it would get down into this level. And then of course, if this level breached, there's a decent chance it goes and tries to test the lows. So they're just some key levels that I guess are worthwhile looking at technically, potentially, checking them out in the future, and seeing if your trade plans make sense around those as well. Like all of these levels will be key.
Just to answer a quick question, I've had it quite a few times. Yes, this video will be on Pepperstone's YouTube channel tomorrow. So yeah, keep an eye out. You'll get an email at some point anyway for being a registrant. But if you check out the YouTube channel tomorrow, Pepperstone's YouTube channel will have a full replay of this webinar for those who are wanting a recap on it.
Okay, so Ty, as we always talk about points-based approach to, I think anything's really important. Like somebody mentioned before as well, they love gaps. I think the thing with gaps is that if you're trading in the direction of trend and generally speaking, the actual news that causes the gap will actually help you out. So learning peaks and troughs and learning how to read direction of trend and understand it more than just moving averages and things like that is pretty important. And you will find that generally things will gap in the direction most of the time. So we're not always going to be trading a highly volatile time like we are now. Sometimes we're going to be trading a normal market, well, in fact, the majority of the time. So by following trends, you will have usually a higher percentage of the time the gaps will be in your favor than against you. And that is important. So you want to have a points-based or price action-based or some system or business plan for your trading. When we talk about trading as well, Ty, I think at the moment it's key for people to focus on certain patterns, double tops, double bottoms, channel patterns, potentially not going to happen as much right now, head and shoulders, inverse head and shoulders, and also triangles. These are the patterns that are very, very good at these times. If you see a double top on a 4-hour on the S&P 500 or on your favorite stock that you're trading or on your favorite currency, it doesn't really matter. They mean something right now because the market is fast, the market is testing levels very quickly, and when it breaks through, especially like a double top, if we see something like this where the market's come up, it's a double top, tests it, breaks through, and at the same time this double top was previous, let's say, support over here before it came back down, this level is so good. If you just focused on finding a level like that where you had the role reversal, you've got a double top, and then you've got the break in the direction of the overlying trend, that is a very, very solid basic plan for your trading system. If you then get a cross of some moving averages, all these types of things together, it's amazing how well that works. So the most important thing whenever trading patterns or price action is wait for confirmation, all right? And then we all get stuck on this one. You might have a double top, and you look at it here and you go, wow, this is a double top. I see it. I see the peak. I see the equal peak. It's a double top. I'm going to short it right here. And you get damn excited about it, don't you, Ty? And you're like, yes, 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 I'm going to get in. And then next day it's over here. It never came down here, and it's all the way up high and broke high. Now, if you go back and you're trying to explain to your friend or your trading partner or whoever why you took that trade, they're going to see it like this, and they're going to think, man, this guy is pretty stupid. So they're going to be like this, and it's like that. And you're like, well, that's not a double top. It just made a new high. It was just a pullback before it broke through. And you're like, well, no, it was double top when I saw it. So think about confirmation is key. We need to make sure that the market has thought about it, it has gone through, and we have a close candle on your desired time frame. Now, this could be a 5 minute, this could be a 4 hour, this could be a 1 hour, it could be anything, but that is the importance, the confirmation. And I can, like Tyrone and I talk about it all the time, it's so important. You need to wait for confirmation.
Most definitely, most definitely. Another question I'm getting, quite a bit, so I might actually answer that out to the public as well. And Thomas may correct me if I'm wrong on this one, but a lot of people are asking about CFDs on the MT4 platform. Now, you need to have the MT5 platform loaded, and you can have CFDs and currencies all in the same account. You don't have to have a separate account to have CFDs and currency. They will appear in your MarketWatch window, but from my understanding, CFDs are not on the MT4 platform. So that's probably why you're not seeing. Is that correct, Thomas? Yeah, so that's why you're not seeing them. Yeah, so you want to be upgrading to the MT5 platform. Just talk to your Pepperstone account manager. It won't cost anything. Obviously, you'll be able to transfer across. But the CFDs are definitely in the MT5, and the list is getting bigger and bigger. So it's very difficult to keep up with the amount of potential trading that you can do between the CFDs and all of the commodities, soft commodities, hard commodities, and currency pairs. There's literally, yeah, you could trade one a day for a year. I think you still would, you'd have some left over. So definitely get onto that one. But there's a lot of CFDs in there, and they are adding more and more basically as they come along. So you want to be checking them out. All the major companies are there.
Okay, Ty, so economic news. Now, obviously during US earnings season, we're going to see a lot of earnings from stocks and companies, but we're also going to see some economic news that's going to impact a lot of currency traders. And we do know that the majority of you guys out there will probably be trading certain currencies. So what we're going to see is that during the month of April, I don't think it's just going to be high impact news. So that's news that is considered red or considered of incredible importance that's affecting the markets. It's going to be all of the news, especially in key economies. So if you're looking at maybe Germany, it's going to be, and they've got a bad result, it's going to be very key to the euro, etc. Italy as well, Spain, all that type of stuff. So before you're placing any trade, make sure you check for news events. If you're trading, especially going to be a stock, and you're using a CFD, and you're saying, okay, I'm going to trade Amazon, and you're not aware when Amazon is meant to be making their announcement for earnings, and you accidentally trade into earnings, that could be very bad for you. So you need to be aware of this stuff, and it's like doing your research. You've got to research before you just click the button, and that's going to be very important. So currently, we'll be wanting to look at as much news as possible. You don't always need to do this, but during high VIX times, as we mentioned, when VIX is above 2025, you are going to need to do it. So the month of April will be very important for you to do that before placing any trades. Ty, we've mentioned this a few times, and I just thought it's always good to give people a bit, of an idea of just a super basic concept. So we talked about that double top, but also I've mentioned this, I put it in a YouTube video a few weeks ago as well, which is just the 1, 2, 3 method, super basic concept, but all you're looking for is key areas of support or resistance that have touched a few times. Now, the reason that it works during these points of high volatility is because when something's touched, let's say multiple times, let's say we see a support and that support's touched 6 times, okay, or 3 times, doesn't matter. When it breaks through that zone and makes a new high, so the resistance has been broken, it means the market is super aggressive on that move. So let's say we see this, the 1, 2, 3, and then price breaks through. So a super simple system would be that when price breaks through that resistance and it's broken through the 3rd time, that's going to be probably quite aggressive in terms of its move. And that is probably if it's as long as it's in the direction of the overlying trend. So if you're trading, let's say a 1-hour chart and the daily is up and you see a 1, 2, 3 break, it's probably going to have a higher chance of success because you're trading in the direction of trend. You can also use things like 2050 to try to figure out crosses, to try to figure out the direction of trend. And all of these will work in stock, they'll work in currency. The concept will work in pretty much anything. So it's more about price action, and price action is such a key indicator. It's the lead indicator Obviously, indicators don't lie. Someone wanted me to mention that last week. You see what the indicator is telling you because it's based on the actual charts. However, they are still lagging. And when you need to be at the forefront of movements, you should be looking at price action. Role reversal, Ty, we talk about it all the time. Very important concept. I've used this slide about almost every webinar. I think it's just important to do it. Where resistance becomes support or support becomes resistance, learn the concept. If you want to be a price action trader, you really need to know that. It's very, very important to know. We also want to optimize our entries, Ty, during times of earnings. If you're trading, let's say CFDs or anything, as we said, confirmation is key, but more importantly, you want to have the stop losses in. So you don't want to just base your trades on, okay, I'm going to trade Amazon and I think I'm going to have a $50 stop loss and I'm not going to put it in. I'm not going to put it in, but I think I'm going to have $50 stop loss because then it's going to be $150 down one day, maybe on a gap or something else. And you're going to be like, oh my God, where was my stop loss? And then you won't take it and then mistakes happen. So try not to do that. Try to use market adaptive stops. What are your thoughts, Ty, on that one?
Yeah, most definitely. Look, that goes for any trading that you do, and CFDs are certainly no different. So market adapting any form of trading idea is actually important. Stop losses, take profits. It's what really keeps you in the game, and it's the only way that you can actually stay relevant to what the market's actually doing. It's very, very important that you do that. Just in terms of patterns, I've had a few questions about what some of the patterns we were talking about mean as well. I've just posted in the chat room a pattern cheat sheet that people can download for free. It's a good idea to have this somewhere, especially if you're not familiar with some of the patterns that we've talked about. Print it off, put it on your wall. It'll give you a very quick reference point to understand what the pattern looks like and what the expectations are of them, because the good thing about patterns are they are very market predictive in terms of take profits and stop losses. So we use them, we love them, and so print it off. Just click on the link and you can print that cheat sheet off and keep it as a reference guide next to your computer.
Okay, so create trading system based on a business plan. As we mentioned, this is just a bit of an example. We need 3 reasons. Never use one reason. Always use multiple reasons to place a trade. One thing will not work by itself, generally speaking, and that's just because when you think about it, you need lots of people to be in there as well. One thing I've learned over the years is that if you let's say using 3 things to get in the trade, so using these 3 things here, we place a trade and then you start to see, well, hey, wait a second, there's a moving average cross as well that happened after. So we're entered here and then it's going up and then moving average happens while it's here. Well, we know all the moving average traders are getting in all of a sudden. And then we see some other indicator, maybe it pulls back, goes up, and then we see a stochastic indicator showing that the oversold is going up, it's crossed above, and we can see all the stochastic traders are in. And when you understand all those different indicators and the different methods, then what you'll notice is that if you're getting in first, let's say with your price action, you're going to see all of these other people entering the trade in the direction as things cross. And that will give you the confidence, because confidence is a big thing when it comes to holding a position. I'm sure everybody's taken a position out early. It's very easy to do so, but it is a long-term mistake. So you want to basically be holding it for what you're meant to be taking. Just another shout out, Ty, for the Telegram group. Obviously really important. We really love getting people into that. So that is important. And I did want to mention the FX Evolution Pepperstone promotion, so the one that we're running at the moment. So look, we've done, I guess, a lockdown special. It's mostly because we know that people are at home. There's a huge amount of interest in learning right now. And look, we feel we've got one of the best around. I think our reviews and people that have done the course would say the same. We've got a private Telegram group for people to share their trades that have done the course. And there's been some great ones even come through this week, Ty. So we do run this at the moment. We'll put it in the chat so you guys can see it. But yeah, obviously we're running a super deal, and we've never really done this deal before, but we're doing it because we think it's pretty important to do something like this during this time.
Yeah, most definitely. Look, I think the what we take out of it, like if people understand, a lot of people are doing these webinars with us every week now, which is really, really good. And it's probably important for us that everybody understands what we're talking about as we're talking about it, rather than trying to explain things that you probably would normally know. So the basic things like price action, being key, all of the key indicators that we use, the patterns that we use, you'll get a lot more out of our webinars if you actually understand what we're talking about without us having to explain it or without you having to research it. So that's why we've tried to make it as affordable as we can for everybody out there, because especially in our teaching webinars and our live market webinars, which we do at 9 o'clock every Wednesday, they're very quick. We move very quickly through them because we cover a lot of pairs, all of the market analysis is live. So we really ideally need people to understand what we're talking about so they can get the most out of it. So that's obviously an important factor. So yeah, definitely log into that if you can. But again, a shout out to the Telegram groups. The Pepperstone one gives you really, really important information on, all of the news that's coming out. And like you say, you can set alerts for it. You don't have to like literally be watching it. You can set alerts in there. So as soon as Pepperstone puts something out that's important, whether it's a news release or something that's happened in the market, you'll get an alert. So it's not like you have to keep watching it every 5 minutes. Theirs is a little bit different to ours. Our one, traders do interact with each other, which is great as well. So that requires, you probably wouldn't want an alert on that one. You'll be getting one every 10 seconds. But yeah, for the Pepperstone one, you definitely want your alert set so you will be completely up to date on any news that gets released at any given time. So it's really, really important. And it's most importantly, it's free. So it certainly won't cost you anything, but it's a very, very good resource to have at your disposal.
So the last ones I want to end on, Ty, is basically I want to talk about the yen. Just want to talk about that from an economic standpoint. I think the yen is going to move relatively fast this month, especially ahead of earnings. So we're seeing this 107 area come under pressure in terms of a support pressure. Got a peak trough, lower peak, lower trough concept here. Obviously a break below this really exposes a fairly large move. So if that did happen, it could go the same distance again back into the lows. It's always interesting to see how the market preps a concept. So you might have a peak and then it goes down, the first move comes back, pulls, and then breaks again. And notice how these distances are the same distance, but it also predicts the low. So it means the market's thought about this concept. If it does get through, this could happen. Now, the reason why is because market is looking for hedges against the problems at the moment in the economies. You can see this in gold. If we look at gold and we look at a weekly, we've been calling this for a long time, been talking about Ty, the flag that was formed here and the fact that the distance that the flag was going to go, we took that distance, was going to be into the previous highs. So you can see very strong predictor in terms of the 1780 kind of area. I'm not saying it gets there tomorrow or anything like that, but it's interesting to see gold broke a new high this week while the S&P has gone to a new high on light volume. And then, it kind of counteracts each other. So it's basically a bit of a hedge against the problems happening at the moment and inflation and all these types of things. So it'd be interesting to see what happens with gold, but I think gold's been a good scalp. And it has definitely been an interesting kind of trading period for gold and will continue to be so. So Ty, Q&A, have you got any great questions there? I know you've answered quite a few of them throughout the webinar.
Sorry about the typing. You may have heard in the microphone. I have been typing, like I'm getting very, very quick at typing. So a lot of these questions have been answered. But to cover most of them, look, it's probably just retracting. Yes, it is definitely recorded. You'll see it tomorrow. You'll be emailed with a replay, but you will be able to see it on the YouTube channel, the Pepperstone YouTube channel. Is definitely going to have it up tomorrow morning, and as they always are. So basically anyone that you've missed in any of the previous weeks, if you have any, or you want to recap, just go to the YouTube channel. They never take them down, they're always there. And yeah, so it's a really, really good resource to catch yourself up. A very quick question there. SMA is a simple moving average, Dominic. So SMA is a simple moving average and EMA is an exponential moving average. So yeah, very important. Also, yes, the webinar that we have been talking about does start in 10 minutes. So the live webinar starts in 10 minutes. I'll post that link in there again for the people who have missed it. But yeah, it is tonight. We do run consecutive webinars. And there is
Good question.
there's also another webinar. Just be mindful as well that Pepperstone are doing one us on behalf of Pepperstone are doing one every week for at least the next 3 or 4 weeks. So yeah, definitely keep an eye out for the registrations, because we are doing a series basically every week, and the more people that turn out, we're getting fantastic turnouts. So the more people that turn out for it, probably the longer they'll keep it going, because ideally we want to get as much out to the people as possible, and we are always going to try and put a live element of what's happening in the markets as it stands every week. So they always will be different. You'll be learning something new every week, and we'll be trying to apply it to the markets as we see them.
I just got one last question, and it's a bit of a loaded question, but what is the problem with having so much debt in the US? I understand USA is taking on a lot of debt, so how will it harm the stock market? It might not necessarily harm the stock market, it might inflate the stock market, and that's what's happening right now. When you give the stock market effectively free loans and free cash, not that it's 100% free, but you know what I mean, injection into the economy, what happens is it makes the stock market perform really well over the long term. So we saw that come out of the GFC. We saw some pretty incredible moves as the QEs came through, QE1, QE2, QE3, QE4. And then, of course, they started tapping it back before this current crisis. So look, there's all sorts of, it's a super complex economic standpoint. I'll leave that one up to Chris, because Chris is really great at that kind of top-down economy stuff. But realistically, yes, long term, if you keep pumping money into the economy and making these kind of free loans or partial free loans, what will end up happening is the stock markets, or the stocks, will do incredibly well. They'll make bumper profits. Makes sense. All right.
It does.
Well, thank you very
actually,
much, guys.
We want to probably mention that actually. We've got Chris is actually joining us.
He is, yeah.
Is next week. So yeah, Chris is actually joining us on our webinar next week. So that's going to be a really, really good one. All 3 of us will be here to be able to answer questions. Can't wait for that one. Actually, it's a Pepperstone first, where we've actually combined the fundamental expertise of Chris with our technical analysis wrap. So it's going to be a really, really good.
How good does that get?
It's going to be really, really good. So yeah, can't wait for next week. So make sure you register nice and early for next week's webinar, because it's going to be a beauty.
Awesome. All right. Well, thank you very much, everybody, and we'll see you soon. And stay, of course, safe. Hopefully, you have some great trades out there. Speak to you soon.
Thanks, guys. See you next week.
See ya. Bye.